Welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Natalie W., who says, I took out a 30-year mortgage for $773,000 at 7.18% interest to build a new home. But my current home has no mortgage and should bring about $500,000 when I sell it. I'm considering a refinance, but am worried about paying too much for closing costs. Should I refinance the new home loan or just pay it down with the $500,000 proceeds and send an extra $2,000 monthly? That's a great question, Natalie. Thanks so much for sending it in. When you're a homeowner, your mortgage payment is likely your largest monthly expense. So it is very smart to consider reducing it and your interest expense by refinancing when it makes sense. So this podcast will review how to know when a mortgage refinance is right for your situation. Thanks for downloading episode 913 of Money Girl. I'm Laura Adams, an award-winning author, speaker, on-camera spokesperson, and founder of The Money Stack. That's my free Substack newsletter. You can learn more and connect with me at lauradadams.com. That's also where you can email your money question. You can learn more about my books and courses and sign up for the free Money Stack newsletter. You can also record a brief question or comment when you call our voicemail at 302-364-0308. I look forward to hearing your money question. All right, so let's talk about mortgage refinancing. Refinancing is a common transaction where a borrower takes out a new loan to pay off an existing loan. The new debt could be with your same lender, or it could be with a different institution. And the most common reason that you might want to refinance is when you can get a lower interest rate, which decreases the interest you have to pay and perhaps your monthly payments. So I'm assuming that's what Natalie's mission is. You know, she's probably feeling like she got that mortgage when rates were higher. Now they're lower. And so, she's trying to think about saving money, which is a really smart thing to do. When you take out a mortgage to buy or build a home, various factors determine the interest rate you get offered. While your credit, the down payment you pay, the income history that you have, all of that is critical. Lenders are also going to base mortgages on the prevailing interest rates. And of course, those fluctuate depending on what's happening with monetary policy and the Federal Reserve. Freddie Mac shows historical data for interest rates on 30-year mortgages since 1971. And if I look back to January 2021, that was when we were at a low. A fixed-rate 30-year mortgage was 2.65% on average. In October 2023, the same loan was 7.8%. So Natalie didn't take her loan out at the peak. It got up to 7.8% or thereabouts. Now, in March 2025, the going rate is about 6.6%. But as I mentioned, it's always fluctuating. And since rates do change periodically, your mortgage may significantly differ from the rates you could qualify for today. However, a good rule of thumb is to refinance only when the current rate dips at least 1 percentage point below what you're paying. And the reason that's so important is because, as Natalie mentioned, it does cost money to refinance a mortgage. You're wise, Natalie, to be concerned that the closing costs could be too high. Closing a loan means you're going to pay fees to various companies. It could be, in addition to your lender or your mortgage broker, a property appraiser, a closing agent or attorney, and a surveyor, or even more. Plus, you have fees required by the local government for recording the mortgage, and even more costs, just depending on where you live and what's customary in that area. The total upfront cost of a refinance depends on the lender and the property location. It could be as high as 3 up to 6% of your outstanding loan balance. So the trick to knowing if it's worth it is to figure out when you would break even on those refinancing costs. You're going to lose money if you pay for a refinance, but you don't keep your home long enough to recoup the total costs. But if you own the property beyond the financial break-even point, or BEP, you'll save money in the long run by doing a mortgage refinance. You may be able to roll closing costs for a refinance into the new loan, which means you would have nothing or little to pay out of pocket. However, adding those costs is going to increase the amount you have to borrow, and it may also increase the interest rate you've got to pay for the life of the loan. So for those reasons, be very cautious about financing the costs of a refinance and carefully compare your options. In most cases, it is not going to be worthwhile, to roll those costs into the loan. Factors in a break-even point calculation depend on various factors, including your interest rate on the old loan and the new loan, the total closing costs you have to pay, the income tax rate you have, so that comes into play with the mortgage interest deduction, the remaining time that you have to own the property, any prepayment penalties if applicable. However, you can use a really quick break-even point formula to get a general idea of whether a refinance would be worthwhile for you. So the formula is your total closing costs divided by your monthly savings. For instance, if your closing costs are $5,000, and doing the refinance means you're going to save $150 a month on your new mortgage payment. In that case, it would take 34 months or almost 3 years to recoup the cost. So the calculation is $5,000 in total costs divided by $150 in monthly savings. So that equals 33.3 months to break even. And if you need some help crunching your numbers, there's a really great refinance break-even calculator at dinkytown.com, and I'll put a link to that in the show notes. Now, if you believe doing a refinance could be wise for your situation, you really need to consider whether you qualify in the first place. Lenders have different underwriting requirements, but most require you to have a minimum amount of equity in your property. Equity is the difference between your home's market value today and what you owe on it. A critical ratio for refinancing is known as the loan-to-value, or LTV. For example, if your home value is $300,000 and you have a $150,000 mortgage that's outstanding, you have $150,000 in equity. That's an LTV ratio of 50%. But if you owed $250,000 on a $300,000 home, you would have a much higher LTV. It would be 83%. You typically need an LTV of less than 80% to qualify for a mortgage refinance. Now, lenders may still work with you if you have a higher LTV and good credit and income, but they may charge you a higher interest rate. Now, if you have an existing FHA or a VA mortgage, you may qualify for a streamlined refinance program that requires less paperwork and less equity than a conventional refinance. So check out the FHA refinance program and the VA refinance program to learn more if you have those types of loans, and I'll put links to those programs in the show notes. So let's talk about 7 situations when refinancing a mortgage makes really good sense. Number 1, you could get a lower interest rate. If you're like Natalie and got a mortgage when rates were higher than they are now, you may be a good candidate for refinancing. However, as I mentioned, you should carefully research the cost and the break-even point. And typically, it's not going to work unless you are able to get a loan that's a full percentage point lower than what you're currently paying. The second situation is when you have an adjustable rate mortgage, or ARM. Buying a home with an adjustable rate mortgage has many advantages, like a lower rate and a lower monthly payment. That can make qualifying for a larger loan easier than with a fixed rate mortgage. Now, with an ARM, your monthly payments get smaller when interest rates decrease, which is great. But when ARM rates go up, your mortgage payment increases. There are caps on annual increases, but your rate could double within just a few years if rates have a significant spike. So if you have an ARM, instead of worrying about how high your adjustable rate payment could go, you might refinance to a fixed rate loan. That move would lock in a reasonable rate that can never change, making it easier to manage money and stick to a budget. The third situation is you don't plan on moving for several years. Once you know what a refinance will cost, be sure you'll own your home long enough to pass the break-even point, or as I mentioned, you'll lose money. For most homeowners, it typically takes owning your home for at least 3 years after a refinance to make it worthwhile. Number 4, you have enough home equity. As I mentioned, you typically need at least 20% equity to qualify for a refinance. If you have less, you may still find lenders that will work with you. However, unless your credit is excellent, you'll typically pay a higher interest rate when you have low equity. Also, if you don't have 20% equity, lenders charge private mortgage insurance, or PMI, and adding that to your new loan could cut your savings and give you a much longer break-even point. Number 5, your finances are in good shape. The higher your income and credit and the lower your debt, the better your refinancing terms will be. If you're unemployed or your credit took a dive due to a hardship, wait until your financial situation has improved before making a mortgage application. Good credit can save thousands in mortgage interest. Number 6, you need to change a co-borrower. Refinancing is one solution if you want to remove a co-borrower, such as an ex-spouse or partner, from your mortgage. However, if one borrower doesn't have sufficient income and credit to qualify for a refinance, your best option may be to sell the property instead of refinancing. And 7, you want to tap home equity. You may qualify for a cash-out refinance if you have ample home equity. That allows you to get a larger loan than your existing mortgage, so you'll walk away from the closing with cash. However, I will say you may want to also take a look at a home equity line of credit, or HELOC, which could come with lower closing costs. So let's get back to Natalie's question. Should I prepay my mortgage or refinance it? Well, knowing when to refinance your mortgage or keep it and make one or more additional payments depends on your financial situation and goals. Since Natalie is building a home, let's assume she plans to stay there for at least several years, and that's essential for making a refinance pay off. Another consideration for prepaying or refinancing a mortgage is how long you've had it. Refinancing starts your new loan on day 1. That wouldn't be a downside for Natalie because she recently got her new construction loan. However, if you only had 10 years remaining on a 30-year mortgage, starting over with another 30-year mortgage may not save enough interest to be worthwhile. With a fixed-rate mortgage that amortizes, the total monthly payment is the same, but the portion allocated to interest is higher in the early years and lower in the later years. Refinancing doesn't make sense when the going mortgage rate is too high to generate savings. Natalie said her rate is 7.18%, and the 30-year fixed-rate mortgage as of this podcast is 6.6%. Therefore, I recommend waiting to refinance until rates drop a percentage point to 6.18% or lower. Now, if rates don't decline enough, paying extra on your mortgage principal as a lump sum or monthly amounts could be a better way for Natalie to reduce her long-term interest costs and pay off the loan faster. She could always prepay her mortgage with a lump sum or monthly payments and refinance later if rates drop. However, prepaying a mortgage is only wise when your finances are in excellent shape. Natalie didn't mention her situation, such as whether her retirement investments are on track or if she has other debt. But since she can afford to pay an extra $2,000 monthly for her mortgage, I'll assume her finances are solid. If you want to learn more about the pros and cons of paying off a mortgage early, check out podcast 836 called Should I Invest Extra Money or Pay Down My Mortgage? And also check out number 774 called How to Know When to Invest or Prepay Debt. If you decide to refinance a mortgage, maximize your savings by comparing rates with multiple lenders. Interest rates can vary like 0.5% or more between lenders, and that really adds up to a significant difference in your monthly payments and potential long-term savings. Sometimes your current lender may be willing to waive certain fees if services like your title search, survey, or appraisal are less than 6 to 12 months old. So, Natalie, you might want to take a wait-and-see approach and monitor rates for a little while to see if they are going to trend down. And if not, you may be on the right path to go ahead and prepay your mortgage. And just depending on how your other goals are looking, using your extra $2,000 a month for the mortgage may make sense. But if you feel like you're a little behind on retirement, or maybe you don't have enough emergency money, or you're behind on other goals that you want to achieve, I wouldn't put the mortgage ahead of those goals. In most cases, you're better off investing your money than you are to prepay a mortgage that's got a relatively low rate. So you really want to look at your options. What is the opportunity cost of that money before paying extra to your mortgage? I want to thank you so much for the question. I really appreciate it and know that other people have likely got the same questions. So it's great when we can share these questions and learn from each other. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that I want to thank. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.